Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining me today is Aashish P. Somaiyaa. He's CEO, WhiteOak Capital Asset Management Limited. Welcome, Aashish.
Hi, thank you. Thank you for having me, Ruchira.
Good to have you back with us. Now, let's begin today's conversation with your column in Mutual Fund Insight, February 2025 issue, Markets, Mindsets, and the India Story. We've seen an incredible surge in SIPs and trading accounts during this market cycle. So, what do you think has fundamentally changed to drive this explosive growth in investor participation?
See, I think, there is always if you go by commentary, television, the news, and, general chit chat, if you go by commentary, a lot of people seem to think that, stock market is booming. So it is drawing in a lot of people into the industry. And, everybody seems to be attributing it to cyclical phenomena. Because it's true that when the markets are making headlines, when the markets move from economic times to the tabloids, correct? It draws in or sucks in a lot of people, correct? But I would say that, what has happened in the last few years is that the India story or the demography that we have been talking about since time immemorial, that demography is actually now playing out, right? Because the way our population pyramid was shaped 10, 15 years back, most people in India were teenagers or kids. And today, finally, you've hit an inflection point where most people in India are, between 15 to 35. We are in the late teens or the youngsters, correct? That the median age is nearing now 30 or maybe just a bit lower than 30, right? Which means that we are all in the prime of our, as a country, we are in the prime of our youth. So what is happening is that while the normal tendency is to ascribe this, huge influx of investors, normal tendency is to ascribe it to cyclical phenomena. But apart from that, what we should also understand is that it's just that there are so many people who are participating. It's just the sheer number of people. And plus, for all this large number of people, the number of options available has systematically gone down. Look, even if there were so many people 20 years back, they wouldn't have come to capital markets 20 years back, because 20 years back, our interest rate structure was such that the government of India was, I remember when I started my career, RBI used to issue bonds on behalf of the government. They will call, GOI relief bonds. That was paying some 11-12% tax-free. So what happens is, if our demography was such that even 20 years back, we had so many people. 20 years back, most of us were kids. We didn't have so many people. But even if for a moment we thought that we are 15 years back, 20 years back in our demography, then those people would have been doing fixed income because, post office gave 10%, State Bank gave 10%, HDFC and Bajaj and Kotak and all these guys were borrowing, NBFCs were borrowing at 16-17%. But today what has happened is not only the demography has changed, people have come of age, but fixed interest rates have come down dramatically. Habits have changed, right? Technology has changed, regulation has changed, digitization, correct? So today, even if today all these youngsters, if you tell them, beta, go to the post office, it will give you 11%, they will not go. They will say, iska UI, UX bahut kharab hai. Correct? So, I think that it's not just cyclical phenomena. It's not just stock market performance which is driving these people. Last thing I'll tell you is that today's youngsters, their education level, knowledge, information, risk appetite, aspirations are very different from what it was 20-25 years back, right? So I think it's a lot of it is structural, why so many people are, and I think it is here to stay. There'll always be some people who will be motivated with market performance and some who will get demotivated if markets did badly for some time. But largely it is structural, and we should get used to seeing more capital market participation.
Now, you've highlighted a common bias where India's current growth is often attributed to cyclical factors rather than structural shifts. So, how can investors distinguish between the two and, avoid being swayed by short-term narratives?
Yeah, see, because that's what see what happens is that everybody, since 20 years back, and the benefit of being in a capital market linked industry like mutual funds is that, you generally, we end up meeting a lot of people who follow the economy very closely, or, who rightly or wrongly even make predictions about the economy. Some of them are right, some of them are wrong, but all this talk about India's demography and Amrit Kal and, period of high growth, I think that is grounded in some maths and some science, grounded in economics, right? Now, this has been predicted since last 20 years. Being in the industry, since 20 years, I have been seeing reports and presentations and, future forecasts or prognosis or hypothesis of investing saying that, demography will change. We will move from existential consumption to premiumization of consumption. And, we will see this per capita income changing, etc. All of these have been spoken about and forecasted since 20 years. But now when it is happening, people are not able to recognize that this is the shift we were talking about all along. I think that's the key thing. It's one thing to forecast. It's another thing to be alive to it when it is actually playing out.
Right. Okay. You were talking about India's demographic advantage, and so the young and growing population, it's a key driver of long-term economic potential. How can investors position their portfolios to capitalize on these demographic tailwinds?
See, I think my sense is that one is it applies to the equity market at large, right? What is most important first is to participate in the growth. The only way to participate in economic growth is to participate in equity as an asset class. The second thing is not to be flirtatious, because what happens is that if you see 15-20% appreciation, or you see a couple of years of great performance, and then you start fiddling with, okay, this is already run up a lot, let me book profits, we'll re-enter later. Or, my neighbor is getting more return, I'm doing mutual fund, this guy is doing FNO, let me do that, let me take shortcuts. So first is to participate and participate meaningfully. Second is to participate and participate without distraction, without flirtatious behavior, participate on a consistent and sustainable basis, right? I always tell people that, forget about future and Amrit Kal and forget about the journey in future. Just understand one thing. In the last few years, when India was going from nowhere, from a frontier economy to just about a developing economy, in 31 years, 32 years since our liberalization, Sensex has compounded 14% CAGR. Imagine. Now, when that was the situation, no technology, no infrastructure, no sophistication in capital markets, right? No private sector so-called to speak of. It only came up in last 20 years, right? Still, it is 14% compounded over 32 years. So if you hadn't done anything in the last 30 years, your money should have doubled every 5 years. That is the rate at which we have grown. I would say our next few years, not in terms of returns numbers, but our next few years as an economy, as a country of people, I think our next few years are going to be better than in the past. So first is to participate. Second is to participate meaningfully. Third is to participate consistently. I think that is something which is very important. Now, if you were to talk about sectors, I think the biggest impact will be seen in financial services, in consumer, and manufacturing. That is my sense.
Okay. You've also spoken about the tendency of older generations to underestimate the capabilities of the younger investors. Could you elaborate on this bias and its implications for investing mindsets?
So, see what happens, Ruchira, for people in our industry. Like I'm in the mutual fund industry for now 25 years. And one of the things in mutual funds, wealth management, insurance, in all of these industries, it demands experience. It demands track record, correct? So what happens is that more often than not, people at the helm of affairs, when it comes to wealth management, investment advisory, investment management, in a lot of these professions, because of want of experience, track record, qualifications, so many things, the people at the helm of affairs are, generally in their 50, 45, 50, 55, right? But our clients, bulk of our clients, like I can say for myself, for our firm, I think north of 50% of our clients are below age 35 right now. because that's how the demography is changing. I'll give you a simple example, Ruchira. If I told you 20 years back that XYZ person is extremely rich, successful businessman, what age would it strike in your head?
50, mid-50s.
Right? So 55, 60, 55. Today, if you say successful entrepreneur, successful businessman, rich person, what age would you think of?
No,
You might
probably.
still think 55, 60, but highly likely even 45, right?
Right.
So the age at which people are earning more money, the age at which people are becoming HNI or prosperous or becoming successful entrepreneurs. I mean, today in India, a lot of billionaires are in their 30s, right? In the US, maybe even lower, right? So the age at which people are becoming prosperous, the age at which people are becoming rich is going down. Any which way, because of demography, on an average, the age of our investors is also going down. So what is happening is that on one side are the professionals and a lot of the people of my generation who are running the affairs of these, industry and, these service providers. And increasingly, our customers are getting younger and younger. Correct. And now when I see a lot of commentary happening in the industry, I find that a lot of people say that, all these youngsters, they've come in the market after COVID. They have come in because the market is going up. They haven't seen enough volatility. They haven't seen any downside. First hint of trouble, these people are going to run away. They think that market is too easy. So these kind of judgments I see ad nauseum on social media, on television, and in many publications also. Now, my point is that if you are going to see today's youngster with the lens of my youth, now how I reacted if the market fell 20, 30% in the late 90s or early 2000s, how I would have reacted if market fell 20, 30% was very different from how today's youngster will react, right? Correct? What was the regulation back then? What is the regulation today? The framework is far more sophisticated and totally evolved. It's completely changed. What is the level of education of people? What is the level of prosperity? Right? What is the level of risk tolerance, aspirations? It's a different world. It's a different country altogether. If some people have entered the market through COVID, yes, they have seen upside. But it's not like they've not seen volatility. I know for a fact last 4 years, there is at least twice market has fallen 30%. Okay. So, I think that I think today's youth is not going to panic if market falls 20, 30%. I think they're different from what we were 25, 30 years back. And that's why I said, the industry, the market is different, technology, regulation are different. But these people are also very different in terms of their risk appetite. And by the way, last thing I'll tell you, market falling 20, 30% or losing 20, 30% in the stock market 25 years back was the equivalent of gambling.
Yeah.
Today, market falling 20, 30% and somebody's portfolio being down 20, 30%. I mean, on a lighter note, as a stock market, if you lose money, it's a legitimate way of losing money. It's no longer compared with gambling. So, and every generation thinks that the next generation doesn't know enough. But that's not the real history of the world. The history of the world shows that every generation has turned out to be smarter. And that is also part of evolution.
Now, coming to the last question, market corrections and cycles can, they can really test even the most disciplined investors. So what strategies can help them stay focused on India's long-term structural growth story during turbulent times?
See, like I said, never take risk or never expose your portfolio to extremes. We might all be wanting to maximize. But long-term consistent wealth creation is not about maximizing. It is about optimizing. See, maximizing means that put all the money into small caps, put all the money into this latest fad, latest factor or latest sector, and let's maximize. I don't know how much it will maximize, but every once in a while, it will give you such a shock that it will kill your staying power in the market.
Right.
So first is not to get exposed to extremes, not to maximize, only try to optimize. Because optimization helps you stay for long term and helps you be consistently participating in the growth, right? So a fair assessment of how much risk you can tolerate. And like I said, related to the concept I said about maximizing is also what I said, being too deterministic. So don't be too deterministic, be open-minded. Like I said before, yes, Amrit kal aayega, lekin kal subah nahi aayega, and we are not going to get there on a straight line. We are going to go through many ups and downs. And through those ups and downs, you will need to have staying power in the market. If you expose yourself to too much risk, you'll get thrown out, you'll not be able to participate. So I think these thoughts or these considerations are very important to stay there in the long term.
All right. So don't maximize, optimize, and be open-minded. Well, thank you, Aashish, for sharing your insights and diving deep into your columns with us. We look forward to having you again. Thanks.
Thank you. Thank you very much.